Can you give too much?
Well, this is where we get into where the IRS has prevailed. You know, I guess about 10 years ago now, and it's hard to think it's that long ago, but you know, I think the family limited partnership area, all the taxpayers and the tax planners and lawyers were riding high because of all the victories that they had in this area, you know, on the valuation issues. And then the government came in and basically said, well, we've got this statute, which we'll call it 2036, and what that says is if you give something but you retain a life interest or lifetime control over it, that's in your estate. Mm-hmm. And they were able to take a number of bad facts cases. Okay, one was a local case, the Schottenauer case, where you know, the testimony was that there was no separate bank account for the partnership. There was you know, all the assets of the elderly person were put into the partnership. Mm-hmm. There was the kids really who were supposed to be partners really didn't understand they were partners or what that meant. There weren't any, you know, partnership meetings. It wasn't conducted like a business, and so
it's like everything that you could do wrong.
Yeah, the court. What the court basically said was, look, if you're not going to respect it, you know, we're not going to respect it, and this is just you know, a paper mache, and mm-hmm. we're going to not recognize it, and the tax court went along with them. And that kind of opened up Pandora's box, because then they went to some other cases where they got a much stricter standard, okay? And so the standards today, I think, if there really are 5, I'd say, axioms that you have to apply to your family limited partnership. Mm-hmm. One of which is, okay, you need a business purpose. Mm-hmm. So if you put your house, or you put the duplex you live in, or you put a vacation home that you have into a partnership and you keep the use of it, what they're looking for is you need some kind of business purpose. That's where these things have stood up. And so if you have a piece of commercial property or a series of commercial properties, and they are really the family business, and you do have family members actually running them, then I think that satisfies the business purpose. Succession planning is a business purpose. Mm-hmm. So if you say, look, we want to preserve these real properties for the benefit of the family, and we need to have a succession management, I think that speaks well. So one of the things we like to do, if you have a senior generation in their 80s or 90s, and they actually, you know, own the property or most of the property, we'll have them put it into a family partnership. We'll have the management, the second generation, maybe people in their late 50s or 60s, you know, they'll be the managers. So we don't have the transferor as the manager. So mm-hmm. we have the reality to the succession plan, and then we'll have the you know, then the actual gifts made of the partnership interest to the various individuals, and we make sure that from an accounting point of view, 2 things happen. That's the second thing. The second thing that you have to worry about is you have to actually account for, both in a financial sense and in a tax sense, for the partnership. In other words, you have to abide by the partnership rules. And the partnership rules basically say that, number 1, capital has to be a material income producing factor, and then number 2, you've got to make your distributions in accordance with the capital accounts that are based on that capital. So if you have a 10% interest in the partnership, you've got to give that person, you know, or allocate that person in an economic way 10% of the earnings and profits of the corporation. And if you don't respect that, where people have gotten in trouble is where the senior generation says, okay, we'll form these partnerships, but I want to keep all the money. Mm-hmm. I don't want to abide by the partnership distribution rules set out in Section 704 of the Internal Revenue Code. So that's like the second thing. The third axiom is try to give up as much control as you can. In other words, where these things fall into trouble is where you have the senior people not really giving up control, and I think that's a that's a key thing. The next thing is basically don't structure your partnership in a way where it's excessive relative to the partnership law. In other words, there's a rule that says if you have if your partnership agreement is so controlling, two things happen. Okay, in other words, if that 10% interest is so controlled in terms of how it can be transferred, in terms of its power to protect itself in terms of distributions, then you're going to risk the gift not being recognized. They say the gift's illusory because you're really not giving anything. Mm-hmm. And then the second thing that's going to happen is they're going to basically say that you violate 2036 because too much control is vested with the the senior people. The last axiom is kind of a cross-check, and that is, I always sit down after we've talked about all this and make sure that this works in an overall estate planning sense. In other words, let's put aside the tax planning. Let's look at this and see if our goal of preserving this asset, for the use and benefit of the next generation has really been achieved. Mm-hmm. And so that's kind of how I think you need to approach this kind of planning.
Okay. And I think one of the things I was trying to allude to though, a little bit with the question is there have been situations where basically people have put everything in. They put in their family residence, and there's no way that they could support themselves, pay their bills, without being dependent on that partnership. And so the courts in some of those cases said, well, you've got to retain interest.
Yeah, I think that's the problem, where you put too much in. Like some of the cases, I think the Schottenhauer case, they put in 99% of the assets. And so, where this basically then looks to the IRS like it's just nothing more than a way to try to avoid the estate tax, mm-hmm. blatantly, okay? And where people get in trouble, they put their homes in. See, I think the personal use assets, you want to segregate those from the business assets. And so, because I think people get in trouble, number one, if you commingle your personal assets with the business assets, because it's commingled. Number two, what's the business purpose for putting your house into a partnership? Well, there isn't one, so that taints the whole partnership. And so I think it's important to segregate the personal assets from the business assets. Okay.
Let's see here. We just have a few minutes left. Why don't we highlight a few of the areas where the IRS has been successful in attacking these family limited partnerships?
Well, one is we've alluded to where the people retain a tacit agreement that nothing's going to change. Mm-hmm. All right, and so in the situation where people are just thinking they're doing this paperwork and they're not going to really respect the partnership, and there's a tacit agreement where control and the income is going to go to the senior person who's transferring things, I think that's where you have that's where the IRS has come in and been very successful, because what they come in and they argue, well, there's a tacit agreement that mom is going to retain all the income on this partnership. And then many times they don't have to go far, because what they do is they get the bank account of mom. They see that the money really is going into mom's personal bank account. She's not, operating this, as a business. Mm-hmm. The taxpayers have tried to argue things unsuccessfully, like saying, well, mom's a general partner and she has a fiduciary obligation, mm-hmm. To deal with the money in a certain way pursuant to the terms of the partnership agreement. But then you see how is the money actually spent, and it's used to pay mom's groceries and medical expenses and all that stuff. So there's no reality to the partnership. That's number one. Mm-hmm. Number two is where people rely on saying, well, I am going to get around this this provision in the Internal Revenue Code by having a bona fide sale. If you're going to have a bona fide sale, you have to make sure it's bona fide. In other words, that the terms of it are commercially reasonable and that the values are commercially reasonable. So let's say people say, well, you know, we're not going to do the gifting, because if we gift, then we're going to be subject to this section that says if you give something and you pull it back, then you've got it's in your estate. What we're going to do is we're going to get around that whole section by doing an actual sale. So we'll sell the asset to the children. The children will pay mom based on a note, and that way mom gets the income, but she gets it in a legitimate way. Well, if you're going to do that, you better be sure that the values you pay, you know, the value is fixed by appraisal, in that dual appraisal system that we talked about. And then the second thing is you have to make sure that these terms are commercially reasonable. And then you have to make sure that the money is actually paid to mom. Okay.
So I think one of the ones for us to highlight, because we are getting a little short on time, is just deathbed transfer. So waiting to the last minute. I think
that's always dangerous. I mean, deathbed transfers are always dangerous because they really, and those the IRS has been very successful on, and they've got poster child cases. They've got the people who, you know, are in comas, and these partnerships are being set up, you know, days before death, and that is not going to work because the idea that you're doing it solely for tax avoidance purposes is right there. So you don't want to put all your assets in. You don't want to commingle with personal assets. You want to respect the partnership agreement. If you set the partnership up, you make sure it's run like a partnership. In other words, it's got its own bank account, it's got its own tax reporting mechanisms, it's got its own books, and there are regular meetings, you know, at least once a year, where, you know, you have a business meeting of all the partners, and they're provided with all the information, so you don't run into the situation where, you know, people are supposed to be partners and don't even know they're partners.
Okay. Well, Frank, we're all out of time. Went fast, didn't it?
Well, they did. I'm sorry I get so, you know, but this is a subject that I really like, and it's a real fun subject to talk about, and I really appreciate your having me.
Okay, well, thank you very much for being my guest. Folks, I hope you found this somewhat enlightening and something that maybe you want to get some more information about. And I hope you can join us next time on Financial Insider Weekly.
Thank you. That was